What if I told you that the greatest mistake traders make isn't losing money, but chasing the wrong dream? Imagine thousands of hopefuls staring at charts each morning, hearts pounding with the belief that one secret setup or YouTube strategy stands between them and financial freedom. For a fleeting moment, it seems to work. The win triggers a rush of dopamine, screenshots get shared like trophies, and belief grows. But soon the same method cracks, losses pile up, and accounts begin to bleed. This isn't failure, it's the illusion of success. Welcome to a journey where we strip away fantasies and reveal the truths behind trading psychology. Before we continue, remember, this is education, not financial advice. Your money, your responsibility. Now picture two doors. Behind the first lies consistency, slow profits compounding over months and years. Behind the second lies excitement, wild swings, rapid doubles, and catastrophic losses. Most traders swear they want the first door, but their behavior drags them to the second. They chase glitter and the market punishes them mercilessly. The gurus won't admit this. Trading isn't about predicting the future, calling tops, or beating everyone else with magical setups. It's about building a method where probability bends in your favor. A structure where controlled losses are outweighed by designed wins. Not gambling, not guessing, but mathematics interwoven with discipline, psychology anchored in reality, the story of expectancy, risk, and reward. The truth isn't glamorous. It won't make you a millionaire in a week. Yet history shows the giants of trading. Richard Dennis turning $200 into $400 million. Rakesh Jhunjhunwala building empires with only 40% accuracy didn't rely on luck. They relied on systems that endured. This message is not for those chasing shortcuts. It is for those ready to understand the architecture of success. Across the chapters ahead, we'll expose the illusions keeping traders stuck, reveal the coin toss that uncovers expectancy, explore the 95% trap, and explain the survival math that protects your capital. We'll study rules and backtesting, the process that transforms randomness into edge, the mindset that turns chaos into calm, and the refinement cycle that keeps methods alive in changing markets. By the end, you won't just know about price action, you'll see the truth beneath it. You'll face the choice: remain a dreamer or become a trader. Every trader begins at a crossroads, though most don't recognize it. On one side lies stability, modest but steady profits, risk carefully measured, a curve that grows like a small plant watered daily. On the other side sparkles a dazzling road of fireworks, accounts doubling overnight, intoxicating victories, and the thrill of being right against the market. When asked which path they want, nearly everyone swears loyalty to the first road. Yet when the charts flash and opportunity calls, their hands betray them. They chase signals. They gamble bigger. They skip stop losses. Their actions expose the truth. They are sprinting toward the second road, blinded by the glitter of quick riches. In online communities, the seduction plays out daily. Screenshots of winning trades are flaunted like medals, captions screaming plus 300% in a single trade. Yet the darker side remains hidden. Accounts that vanish, traders who stop posting after losses wipe away weeks of gains. Social media glorifies the champagne moments and conceals the hangovers. As a result, newcomers equate stability with boredom and view slow growth as unworthy. The trap is laid. Statistics sharpen the picture. Studies reveal that 70%, 80%, sometimes 95% of retail traders lose money. The percentages vary, but the truth holds. The majority fail, not because they lack intelligence or ambition, but because they step willingly into the 95% trap. The trap is built on illusion. It tells traders that success is hidden in a perfect indicator, a guru's secret setup, a magical course promising instant profits. It lures them into a cycle of strategy hopping, abandoning one method after a few losses only to chase the next shiny promise. Months turn to years, accounts shrink, hope fades, and still they ask the wrong question. The only question that matters is this: does the method have positive expectancy? Expectancy is the quiet force that separates gamblers from professionals. Without it, even the cleverest looking method collapses under probability. But the trap disguises itself well. It makes traders believe each loss means the method is broken, rather than part of the game. And so the cycle spins endlessly, fueled by desperation. Imagine a trader, let's call her Maya Torres. She discovers Forex through YouTube, types best strategy, and drowns in videos promising 90% accuracy. She buys the course, copies the template, feels unstoppable. But reality arrives like a sledgehammer. Losses appear, emotions surge, her confidence shatters. Instead of calculating expectancy, she blames the method, abandons it, and hunts for another. Months later, her account is bleeding, yet she still believes the answer is out there, just one more method away. Maya is not lazy or foolish. She is trapped in the same illusion that swallows most. Meanwhile, the 5% who survive play a different game. They don't worship accuracy or chase after the illusion of perfect setups. They test, refine, and measure expectancy. They accept losses as a cost of doing business, not as proof of failure. Ed Seykota, one of the legendary trend followers, said it best: win or lose, everybody gets what they want from the market. And what most people secretly want isn't consistency, it's excitement. They crave the rush of being right, the dopamine of doubling an account, the validation of posting profits online. But the market, like a mirror, gives them exactly what they desire: short-term thrills, long-term ruin. History proves the alternative. Richard Dennis, through his turtle trader experiment, recruited people with no prior experience, actors, accountants, ordinary men and women, and taught them a simple system. It wasn't mystical, it wasn't glamorous. It was discipline, rules, expectancy. Their journey wasn't smooth, some endured months of losses, yet over years they carved fortunes out of chaos because they followed rules instead of chasing excitement. This chapter is a warning and a mirror. It forces you to pause and ask, which road are you truly walking? Not which you claim to want, but which your last 20 trades reveal. If your trades scream of excitement, no stop losses, oversized bets, screenshots shared with pride, then you are on the road of illusion. If your trades whisper of risk measured, rules followed, small losses accepted, then you are walking the quieter but surer road. Here's the terrifying truth: 95% of traders lose because they never escape the second road. They confuse activity with progress, thrill with mastery, hope with expectancy. But if you can recognize the trap, if you can resist the glitter and accept the slow, patient growth of the first path, then you are already closer to joining the 5%. This choice is not dramatic. It happens in tiny decisions: whether to move a stop, whether to double down, whether to follow your rule or follow your fear. Each choice pushes you further down one road or the other. So ask yourself now, with brutal honesty, which road are you truly on? If there is one addiction more powerful than the thrill of quick profits, it is the obsession with prediction. The moment a trader opens a chart, the brain whispers, where will the market go next, up or down? Should I buy now? Should I sell before it drops? Uncertainty feels like chaos, and the human mind craves certainty. So millions of traders hunt endlessly for the crystal ball, a guru, an indicator, a secret method that promises to reveal tomorrow's candle with surgical accuracy. History shows the folly of this quest. In 1998, long-term capital management collapsed, taking with it $4.6 billion and nearly triggering a global financial crisis. This wasn't an amateur group. It was run by Nobel Prize winners, the smartest economic minds on the planet, armed with supercomputers. They believed they had solved the riddle of markets. 2 years later, their predictions lay in ruins. Fast forward to 2020, when oil futures plunged to minus $37 a barrel, an outcome no prediction model foresaw. If the most sophisticated algorithms and celebrated experts can be blindsided, what chance does a retail trader have? And yet, in trading circles, a phrase floats like a magic password: price action. Say you're a price action trader and suddenly you sound wiser, purer, closer to the truth. Price action is marketed as the cure to prediction addiction. Read the candlesticks, they say, and you will know what comes next. Patterns like head and shoulders, pin bars, engulfing candles are treated like prophecies. A pin bar forms, surely the market will reverse. A head and shoulders appears, surely a collapse is coming. And when it works once, confidence explodes. When it fails, the trader shrugs and moves on to the next pattern, never questioning the deeper truth. The paradox is this: price action is not prophecy. It is not magic. It is simply the raw language of the market, buyers and sellers clashing, demand overwhelming supply, or supply crushing demand. A bullish engulfing candle does not guarantee liftoff. It only tells us that in that moment, buyers pushed harder than sellers. Like body language, the meaning depends on context. A smile can signal joy or nervousness depending on the situation. A candlestick is the same. Context transforms it from meaningless noise to useful information. Consider a famous experiment at MIT. Researchers generated a random chart using coin flips. Heads, the price goes up; tails, it goes down. They showed this chart to professional traders. Every one of them spotted patterns: head and shoulders, triangles, support, and resistance. They found order in pure randomness. Human brains are wired to detect patterns, even when none exist. This is the danger of uncritical price action. A quantitative analyst once tested the most beloved patterns across 20 years of data: pin bars, engulfing candles, head and shoulders. The results? Most performed no better than chance. The head and shoulders, worshipped as a reversal signal, succeeded just 52% of the time, a coin flip in disguise. But here's the twist. When combined with context, trend direction, support and resistance, and volume, the numbers improved. Suddenly, win rates rose to 55% or 60%. Not spectacular, but enough to build a system. The pattern itself had no edge. The context created one. And yet, traders continue to drown in analysis. They zoom into 1-minute charts, then out to daily charts, covering their screens with lines until the chart resembles a spider's web. They convince themselves that more analysis equals more certainty. In reality, the opposite happens. The more lines, the more conflicting signals, the more hesitation. Paralysis by analysis grips them and opportunities vanish. Now think of Rakesh Jhunjhunwala, who built a fortune with an accuracy rate below 40%. He wasn't right most of the time, but when he was right, his winners were 3, 5, even 10 times larger than his losers. He didn't predict, he positioned. He built systems where expectancy bent probability in his favor. The prediction illusion is seductive because it flatters the ego. To call the top or bottom feels like genius. To post the perfect forecast online feels like mastery. But the market does not reward ego. It rewards expectancy, risk management, and discipline. Every time you cling to prediction, you step into the trap that devours the majority. Every time you anchor your method in expectancy, you move closer to the minority who survive. So here's your challenge. Recall your last losing trade. Ask yourself honestly, did you lose because you failed to predict the market or because you lacked a plan for being wrong? That single question may reveal more about your future than any candlestick ever will. Close your charts for a moment and forget the endless debate over indicators versus naked trading screens. Imagine instead a simple game. I hand you a coin. Here are the rules. Heads, you win $50s. Tails, you lose $1. Would you play? At first, hesitation creeps in. Losing even a single dollar feels painful if that's all you have. But stretch the horizon. Imagine flipping this coin 100 times with a $100 bankroll. Suddenly, the math speaks louder than emotion. About 50 flips will land on heads, yielding $75. About 50 flips will land on tails, costing $50. Net result, $25 profit. Nothing mystical, nothing glamorous, just expectancy at work. Expectancy is the law of trading, though most ignore it. The formula is simple. Win percentage multiplied by average win minus loss percentage multiplied by average loss. That number determines survival more than any indicator or guru strategy. Richard Dennis, who transformed $200 into $400 million, understood this truth at a cellular level. His turtle traders sometimes won only 5 out of 100 trades. 95 failures, 5 successes, yet still they prospered. How? Because their winners dwarfed their losers, sometimes by 20 or 50 to 1. They weren't gamblers. They were probability managers in disguise. The trap is that human psychology rebels against this law. Traders crave accuracy. They want to be right 80% of the time to boast of streaks of winning trades. Accuracy feels safe, but it is often meaningless. A trader with a 90% win rate can still lose money if every loss is 3 times larger than a win. Meanwhile, a trader with a 40% win rate and a 2-to-1 reward ratio quietly compounds wealth. Expectancy, not accuracy, decides outcomes. Consider casinos. The house edge in European roulette is only 2.7%. Tiny, almost invisible. Yet multiplied across millions of spins, it builds billion-dollar empires. The casino doesn't care who wins a particular spin. They care only that the math ensures profit over time. Traders must adopt the same mindset, become the casino, not the gambler. But most traders fail here. They flip the coin 10 times, lose 7, and panic. They forget that probability reveals itself only over large numbers. Short-term randomness blinds them. Some double down recklessly to recover losses, burning their account in a blaze of desperation. Others quit right before their edge would have appeared. The edge is like gravity. It works only when you give it time to act. Let's test the formula with real numbers. Risk $1 to win 1. That's a 1-to-1 ratio. To break even, you need at least 50% wins. Less, and you bleed slowly. Adjust it. Risk $1 to win $1.50. Now break even falls to 40%. You can lose more than half your trades and still profit. Push it further. Risk $1 to win 2. Break even drops to 33%. Suddenly, you can be wrong 2 times out of 3 and still grow. This is why Van K. Tharp devoted his career to expectancy. He showed traders that obsession with accuracy is psychological quicksand. The market doesn't reward being right, it rewards structured asymmetry. Win small, lose big, and you collapse. Lose small, win big, and you thrive. Think of your own trades. If you risk $100 per position and target 200 with a 40% win rate, expectancy equals $20 per trade. Over 100 trades, that's $2,000 in profit. Not from guessing the future, but from structuring the game correctly. This math is cold, unfeeling, but liberating. The irony is that expectancy frees you from the prison of prediction. No longer must you agonize over whether the next candle rises or falls. Your job is to flip the coin again and again with rules that bend probability in your favor. Individual losses stop mattering. Each trade becomes a data point in a long series. 100 flips, 1,000 trades, the math speaks. Here is the brutal truth. Most traders never calculate expectancy. They chase strategies like gamblers chasing hot tables. They boast of accuracy while their accounts sink. But those who master expectancy see markets differently. They don't fear losing streaks because they know the numbers. They don't worship winning streaks because they know variance. They accept randomness, then structure it into profit. So here is your challenge. Calculate expectancy for your method today. Write down your win rate, your average win, your average loss. Plug them into the formula. If the number is negative, stop trading live immediately. Not tomorrow, not next week. Today. Until expectancy is positive, you are gambling, not trading. Once expectancy is in your favor, every loss becomes simply the cost of flipping the coin again. You can have the most brilliant system in the world, tested over thousands of trades, showing positive expectancy in every scenario, and still lose everything. How? By ignoring the mathematics of survival. Risk per trade is not a detail. It is the foundation of staying in the game. Without controlling it, you're a gambler on borrowed time. With it, you are nearly indestructible. Defining risk per trade means setting a maximum percentage of your account you are willing to lose on a single position. Professionals anchor that number small, usually 1 to 2%. Amateurs scoff. How can I get rich risking so little? They ask. That question reveals why amateurs vanish while professionals endure. Let's run the math. Suppose you risk 10% of your account per trade. Just 10 consecutive losses, which probability guarantees will happen eventually, wipes you out completely. But I'll never lose 10 in a row, people protest. Yet even with a system that wins 60% of the time, streaks of 10 or more losses are not only possible, but inevitable across hundreds of trades. Now shrink that risk to 1%. 10 consecutive losses equal only a 10% drawdown. Painful, yes. Fatal, no. At that level, recovery remains possible. Drawdown math is cruel. At 10% drawdown, you need an 11% gain to recover. At 50%, you need 100%. At 90%, you need 900%. This is the mathematics of destruction, ignored until it is too late. Great traders understood this. Rakesh Jhunjhunwala, often called the Warren Buffett of India, built his fortune with an accuracy rate near 40%. He survived not because he was right often, but because he sized his risk, cut losers before they drowned his winners, and never let one bad trade consume his capital. George Soros said it best. It's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong. Risk isn't just numbers on a spreadsheet. It shapes psychology. When you know the worst-case scenario is a tiny fraction of your account, you stop panicking. You stop sweating every tick. You stop obsessing over being right. Clarity replaces fear, and discipline replaces impulse. But knowing this and living it are two different battles. This is where anchors enter the game. Emotions whisper lies in every trader's ear. Greed says, hold on, it will go higher. Fear says, get out now before you lose everything. Hope says, remove that stop loss, the market will come back. These voices destroy more accounts than bad strategies ever will. Anchors, stop loss, and take profit orders are the safeguards that tether you to reality. A stop loss is not a suggestion, it is your shield. It marks the exact point you accept, I was wrong, and I'll pay this cost. Too many traders treat stops like decorations, moving them wider when price approaches, convincing themselves that patience will save them. It rarely does. Without a stop, a small loss can become catastrophic. With a stop, damage is controlled and capital preserved for the next opportunity. On the other side stands the take profit. This isn't about greed, it's about enforcing structure. Your take profit defines the reward side of your risk to reward ratio. If you risk $1, setting take profit at 2 ensures a 1 to 2 ratio. Over dozens of trades, this locks expectancy into your favor. Think of anchors like seatbelts. Most of the time, you don't need them, but when the crash comes, and it will, they save your life. Traders who ignore stops eventually face a collision they cannot survive. Traders who ignore targets often watch winners turn into losers because they never locked in the asymmetry of risk and reward. I once knew two traders who stared at the same EUR/USD chart one morning. The first saw a bullish engulfing candle and jumped in immediately. No stop, no target. He told himself he'd ride it out. The second followed strict rules. Only trade engulfing candles at support, in line with the daily trend, with a stop 2 pips below the low and a target twice the risk. The market dropped 50 pips. The first trader held on, averaged down twice, and finally closed at a catastrophic 300 pip loss. The second was stopped out at 20 pips and moved on. One survived. One was destroyed. The difference wasn't the pattern, it was the rules enforced by anchors. Rules transform chaos into probability. Without them, you don't have a method, only gambling dressed as analysis. With them, you survive turbulence. Pilots don't rely on gut instinct when a storm hits. They rely on checklists refined over decades. That's why aviation is the safest form of travel. Your trading should be no different. Anchors are your checklists. Without them, you crash. With them, you endure. Here's your challenge. Calculate 1% of your current capital. That number is your maximum risk per trade for the next 30 days. No exceptions. No matter how perfect the setup looks, no matter how confident you feel. 1%, always. Then define your anchors. Where is your stop? Where is your target? Write them down before entering. For 30 days, obey them absolutely. Watch what happens not just to your account, but to your mind. Fear loosens. Clarity grows. Discipline takes root. This is survival math, and survival is the first victory. Winning comes later. Every losing trader shares one thing in common: chaos. They enter trades on impulse, close them out of fear, and justify each decision with words like intuition or gut feeling. But markets are not conquered by chaos. They are conquered by rules. Without rules, you don't have a method. You have gambling disguised as analysis. With rules, you transform randomness into probability. Consider two traders, both staring at the same EUR/USD chart. The first sees a bullish engulfing candle and thinks, this must go up. He enters immediately, heart pounding, no stop loss, no target. He's certain this time will be different. The second trader sees the same candle but has rules. Only trade engulfing patterns at support in line with the daily trend, stop 2 pips below the low, and target twice the risk. The first trader ends with a catastrophic 300 pip loss. The second walks away with a small, controlled 20 pip loss. Same chart, same candle, different outcomes. The difference is rules. Rules are checklists. They strip away emotion, force consistency, and protect you from the lies of greed and fear. Think of professional pilots. When a storm hits, they don't improvise. They follow checklists refined through decades of trial and tragedy. That's why flying is the safest form of travel. Trading should be no different. Your rules are your flight plan. But rules don't appear fully formed. They must be tested, verified, proven. This is where backtesting enters the picture, the truth detector of trading. Every trader has ideas. Few test them. Ideas don't pay the bills. Numbers do. Backtesting is the process of taking your rules and applying them to historical data, trade after trade, until the statistics reveal the truth. Backtesting is brutally honest. It doesn't care about your optimism or your hunches. It only cares about outcomes. Feed it your rules. Entry, stop loss, take profit, and watch history tell you whether you truly have an edge. If your method holds up over hundreds of trades, you have something. If not, no amount of hope will save it. Professional firms know this. Prop desks and hedge funds never risk real money on untested systems. They simulate years of data first. They measure win rate, risk to reward, drawdown, performance in trending and ranging markets. Only after the numbers confirm do they commit capital. Retail traders skip this step, diving straight from YouTube strategy videos into live accounts. When losses come, they blame the method and start the cycle over again. They confuse testing with trading, practice with performance. Backtesting not only proves whether a system works, it reveals its personality. Maybe your trend following rules thrive in volatile markets but bleed in ranges. Maybe your mean reversion system excels in sideways chop but collapses in strong trends. These aren't failures, they're insights. Knowing your system's personality lets you adjust position size, expectations, and patience. It tells you when to press harder and when to step back. Here's what separates amateurs from professionals. Amateurs give up after a few losses. They abandon systems prematurely, searching for something shiny. Professionals trust the process. They know backtesting across hundreds of trades reveals the truth. They accept losing streaks as part of the statistics. They refine systems instead of discarding them. But here's the critical rule. Backtesting only matters if the rules remain fixed. You can't shift stops halfway through because this time looks different. You must treat every historical trade as if it were live. Mechanical, consistent, uncompromising. Only then do the numbers mean something. Once you have data, something magical happens. Doubt begins to fade. Suppose your system wins 40% of the time with a 1 to 2 risk to reward ratio. That expectancy means you can lose 6 out of 10 trades and still grow. Suddenly, 3 losses in a row don't feel like disaster. You know the math. You've seen the proof. Discipline replaces doubt. The market will test you daily. It will whisper that this trade is special, that you can bend your rules just this once. That's the same whisper that destroyed countless accounts. Backtesting silences it. When you have statistics etched into your trading journal, you no longer argue with emotion. You already know the truth. So here's your challenge. Take your next trading idea and backtest it 100 times. Not 10, not 20, 100. Record win rate, average win, average loss, drawdown. Calculate expectancy. If the number is negative, stop. Don't trade it live. Adjust the rules, retest, refine. If it's positive, you now have something precious, a system you can trust. Rules and backtesting don't make trading glamorous. They make it real. They replace hope with structure, chaos with clarity. And when the storm comes, and it always comes, they're the only anchors strong enough to keep you alive. At first glance, markets look like pure chaos. Prices rise, fall, spike, and crash with no obvious logic, like leaves tossed in a hurricane. For beginners, this randomness feels unbearable, even hostile. They believe that to succeed, they must eliminate uncertainty, must somehow predict the next tick. But professionals know a different truth. You don't need to control chaos. You only need to tilt the odds slightly in your favor. That tilt is called an edge. Think back to the coin toss game. 50-50 odds, pure randomness. But the moment you adjust payouts, risk $1 to make 2, the game changes. Suddenly you can lose twice as often as you win and still grow. That small tilt, repeated over hundreds of flips, becomes profit. Casinos live by this law. They don't need to win every spin of roulette. They rely on a tiny house edge, multiplied over millions of plays, to guarantee fortunes. Traders must think the same way. Edges rarely come from one rule alone. One filter may give you even odds. Add another. Trend direction, volume, support levels, and the balance shifts to 55-45. Add a third, and maybe it's 60-40. Each layer nudges probability. Alone, they seem weak. Together, they become strength. This is how the legendary turtle traders thrived. Their win rate was often below 40%. Most of their trades were losers. Yet when the rare big trend appeared, their system captured it, and the gains erased dozens of small losses. They didn't fight randomness, they harnessed it. The mistake most traders make is abandoning rules after a few failures. They forget that probability only reveals itself in large numbers. A coin may land tails 10 times in a row, but that doesn't mean heads disappeared. In the same way, 10 losing trades don't mean your edge is broken. Probability doesn't care about your last 10 trades. It only cares about the next 1,000. Your mission is not to avoid losing trades. That's impossible. Your mission is to design a framework where losses are expected, controlled, and insignificant compared to your winners. Once you see trading this way, losses no longer feel like betrayal. They become part of the design. Imagine running a casino. Every day, people walk in and some win. Does that worry you? Of course not. You know the house edge guarantees profit over time. Now, imagine your trading account as that casino. Each trade is a customer. Some take money from you, others pay you. But over hundreds of trades, your edge ensures that you're the one collecting. Randomness will always swirl like a storm. Your rules are the compass. Your edge is the North Star. Follow them with patience, and the chaos that terrifies beginners becomes the very fuel of your success. There comes a moment in every trader's journey when the charts blur, the indicators fade, and the strategies that once seemed magical feel like empty costumes. Beneath all the noise lies a single truth. Trading is not a game of prediction, but a game of psychology. The greatest enemy is not the market, it is yourself. In the beginning, most traders crave the thrill of being right. They dream of calling the top, of catching the bottom, of posting the perfect screenshot. Every win inflates the ego, every loss feels like a personal wound. They hide losing trades, cling to winning ones, and tie their self-worth to accuracy. But the market does not reward pride. It rewards consistency. The revolution begins when you stop asking, "Was I right?" and start asking, "Did I follow my rules?" The outcome of any single trade becomes irrelevant. One win cannot make you a champion, and one loss cannot make you a failure. Each trade is just one in a long series, a single data point in a 1,000-spin wheel. What matters is adherence to the process. Mark Douglas, author of Trading in the Zone, devoted his career to this mindset. He taught that the best traders think in probabilities, not certainties. They don't attach emotion to wins or losses. Each outcome is just part of the larger sample size. Their identity is not tied to being right, but to being disciplined. This shift also redefines loss. A losing trade is no longer failure. It is the cost of doing business. Just as a restaurant pays rent even when sales are slow, just as a shop pays for goods that may not sell, a trader pays losses to the market. Survival depends not on avoiding loss, but on ensuring that losses are smaller than wins. I remember a turning point in my own path. 5 losses in a row left me frustrated and ready to quit. But then I checked my system stats. 40% win rate, 1 to 2 risk reward ratio. 5 consecutive losses, statistically normal, nothing broken. On the 6th trade, I followed the rules again. It won. By trade 10, I was profitable. The difference wasn't luck, it was perspective. With this mindset, you stop sabotaging yourself after streaks of losses. You stop becoming reckless after streaks of wins. You stay steady. You stop viewing the market as a place to prove your intelligence and start viewing it as a place to apply your edge. Here's your challenge. For the next 10 trades, track only one metric, rule adherence. Did you follow your rules? Not profit, not accuracy. Score yourself out of 10. If you can achieve a perfect score, the profits will follow naturally. The mindset revolution isn't glamorous. It doesn't create instant wealth, but it creates something more valuable, consistency. And consistency is the only path that leads traders out of chaos and into mastery. A trading system, no matter how sharp it seems, is never finished. Markets breathe, evolve, and shift like living organisms. What works flawlessly in one season may stumble in the next. That is why the greatest traders never stop refining. They do not abandon their systems at the first sign of weakness. They adapt, sharpen, and strengthen them through an endless cycle of refinement. The cycle is simple but demanding. Hypothesis, rules, backtest, adjust, retest. Every trader begins with an idea. That idea becomes rules, clear and repeatable. The rules are tested against history through backtesting. The results speak. Expectancy positive, negative, or neutral. If the edge is weak, adjustments follow. If it is strong, refinements deepen. Then the retest begins. Around and around until the system becomes resilient enough to survive in the wild. History offers examples written in triumph and pain. Jesse Livermore, one of the most famous traders of the early 20th century, made and lost fortunes many times. Each collapse was not only financial but educational. He refined, adjusted, and learned. leaving behind methods that inspired trend following systems still used today. His story is a warning. The market humbles anyone who believes their system is perfect. Refinement is not strategy hopping. Amateurs abandon methods at the first setback, chasing the next miracle indicator or guru system. Professionals know better. Losses don't mean the system is broken. Losses mean the system is being tested. Refinement means making small, thoughtful adjustments rather than radical shifts. Every system has seasons. Your trend following method may flourish in volatile conditions, but struggle when markets move sideways. Your mean reversion approach may thrive in ranges, but bleed during strong trends. This is not failure, it is personality. Understanding that personality allows you to size positions accordingly, to lean in during favorable conditions and step back during adverse ones. Refinement builds intimacy between you and your system. Over time, you learn its rhythms the way a musician learns an instrument. You know when it sings and when it stumbles. You stop expecting perfection and begin trusting the long-term arc. This relationship creates confidence, and confidence is the antidote to fear. But refinement requires humility. The moment you believe your system is flawless is the moment the market will remind you of your arrogance. The cycle never ends, and that is a gift. Because with each loop, hypothesis, rules, backtest, adjust, you grow sharper and more resilient. Here's your challenge. Look at your last 20 trades. Group them by market condition, trending up, trending down, or ranging. Calculate your win rate in each condition. You may discover your system has a preference. That preference is not a flaw. It is a personality trait. Work with it. Adjust your risk sizing to reflect it. Refinement is endless. It is not glamorous. It is not exciting, but it is what turns methods into edges and edges into careers. Master the cycle, respect the seasons, and the market will reward you with endurance. Strip away the hype, the marketing, and the endless promises of secret strategies, and what remains. Price action at its core is nothing more than the market's heartbeat, buyers and sellers colliding in an eternal tug of war. Every candle, every wick, every close is just a snapshot of imbalance. It is not prophecy. It is not certainty. It is raw data waiting to be shaped into rules. The truth is this: price action only becomes powerful when combined with probability, risk management, and discipline. A bullish engulfing candle is meaningless unless paired with a system that defines risk and reward. A head and shoulders pattern means nothing without rules that anchor entries and exits. The chart speaks the language of the market, but without a framework, you're only guessing. History's greatest traders knew this. Richard Dennis didn't become legendary by chasing patterns. He built systems that transformed noise into edge. Rakesh Jhunjhunwala thrived with less than 50% accuracy because his rules ensured winners outweighed losers. George Soros emphasized not being right, but surviving wrong. Their success wasn't mystical. It was probability woven with discipline. The market will tempt you every day. It will whisper that this trade is special, that rules don't apply, that you can predict the future. But prediction is an illusion. Discipline is truth. The only question is whether you can transform the raw language of price action into a method built on expectancy and anchored by rules. Price action works because it reflects reality. The real question is whether you can work with it patiently and consistently without succumbing to fantasy. You've walked through illusions and truths, through traps that devour traders and rules that set them free. By now, you know that the market doesn't reward prediction, excitement, or pride. It rewards expectancy, risk management, and discipline. The question left is not whether you'll face losses. You will. The question is whether you'll step into the market blind or armed with structure. Knowledge alone won't save you. Reading about expectancy won't protect your account. Nodding at the math of risk to reward won't stop you from blowing up if you keep ignoring it. Change comes only when knowledge turns into action. So here's your challenge. First, examine your method with brutal honesty. Ask one question. Does it have positive expectancy? Don't guess. Don't hope. Test it. Backtest 100 trades. Write down the win rate, the average risk, the average reward. Calculate the expectancy. If the number is negative, stop trading live immediately, not next week, today. Second, define your risk per trade. No more than 1 to 2% of your capital on any single position. Write it into your rules. This one decision can keep you alive long enough to let your edge compound. Survival is the first victory. Third, embrace the mindset shift. From this day forward, stop chasing perfection. Stop trying to be right every time. Focus only on following your rules. After each trade, ask yourself, did I execute my system? That's the metric that matters. I want to build a community of serious traders, not dreamers, not gamblers, but people willing to walk the hard road of discipline. If you're ready to transform your trading, share your numbers below. What's your current win rate? What's your risk to reward ratio? Be honest. If you don't know them yet, write calculating and commit to figuring it out. Let's hold each other accountable, not with hype, but with data. If this message resonates with you, share it with someone you know is struggling, not to boast, but to help them escape years of pain. Sometimes the greatest gift is truth. The truth that trading isn't about magic setups, but about expectancy, risk, and discipline. Subscribe to Trading Psychology, stick if you want more deep dives, no fluff, no false promises, just the psychological and mathematical foundations that separate professionals from amateurs. And most importantly, act. Don't just consume this. Open your trading journal and record your next 10 trades with absolute honesty. Entry reason, stop loss, take profit, and whether you followed your rules. At the end, calculate your expectancy. That number will tell you everything about your future as a trader. The market doesn't care about your dreams, your ego, or your bills. It only respects discipline, probability, and survival. The choice is yours now. Remain a dreamer or join the 5% who endure. Your transformation begins with the very next trade. Make it count. Welcome to the 5%.